Economic uncertainty and economic downturn can bring some very unpleasant consequences along the way. In one case, lenders in particular can get very skeptical about who they're doing business with and who they're extending credit to during these time frames. We're going to cover a little bit of data and some information, some articles that have been coming out the last few months, and we're going to discuss the psychology of lenders right now going into this economic uncertainty and likely economic downturn, and what you need to be doing as a consumer or as a business owner to best position yourself to continue to receive access to credit from lenders in the coming months or coming couple to few years. The first article I want to cover says banks tightening lending standards and prepare for even bigger pullback. This article was created on November 9th of 2022. It states that banks are tightening underwriting standards on all manners of loans. They expect to do so even more so in the case of a recession. Lenders made it hard in the third quarter for both consumers and businesses to access credit, according to the Federal Reserve survey of banks' senior loan officers released the week this article was written. If the U.S. economy falls into recession, more than 80% of banks said that they would somewhat or substantially tighten lending standards for credit cards and loans backed by commercial real estate. More than 70% of banks said that they would do the same for auto, commercial, industrial, and residential real estate loans. That's a big deal. Very large portion of the banking market share is making it abundantly clear that if the economy continues to head in a downward trajectory, that they will restructure their lending criteria and tighten in order to be more cautious on who they're extending credit to. The second article I'm going to quickly cover explains a bit of why they are skeptical. So this article says younger consumers are falling behind fast on loan payments, according to the New York Fed. This article was created February 16, 2023, so just a couple of days prior to this recording. About 3% of credit card loan borrowers in their 20s and 30s became more than 90 days past due last quarter, which was the fourth quarter of 2022, compared to 1% of those in their 60s and 70s, according to New York Fed research. So, with this data in mind, now you can get a bit of a glance inside the mind and the psychology of lenders around the country. They are looking at the data internally and they're looking at external data sources to observe the behavior of borrowers during these economic times. And what they're finding is that more and more Americans are starting to struggle to make their payments. So a company, any for-profit entity's motto is going to be to maximize profits and to minimize losses. For a lender, that means they have to become extremely cautious on who they're lending their money to when things are economically uncertain like they are now. The trend is blatant. More and more people are going to start falling behind on their payments as layoffs kick up, interest rates get more expensive, and inflation continues to take hold in our economy. People are having to pay more for goods and services that they at one time could fix in their budget and control, while wages are not keeping up with inflation. And in some cases, people are getting laid off depending on what sector that they're in. Now, we do have a strong job economy, but there are vulnerable sectors, like the tech sector, for instance, that's experiencing tens of thousands of layoffs in the last handful of weeks to month or so. So just like anybody would be during those skeptical and uncertain times, you start to play it a little closer to the chest, and lenders are going to do the same thing. Many of you as small business owners and consumers, and majority of my audience, believe it or not, are actually in their 20s, 30s, and 40s. This information is particularly pertinent to you because you as a consumer or as a business owner still need access to capital to continue to function and to grow financially. So you need to understand how lenders are thinking, what concerns they have, and how you can position yourself to remain or become a prime borrower during these tightening times. So what are some tactics that you can take along? Well, if you're a consumer, you want to do one of a handful of things. You're first going to want to make sure that you have created or done your best to maintain a strong income during this time. Ability to repay is going to be essential. lenders and creditors are going to be paying very close attention to job instability or pay cuts. If you went from full-time to part-time, they're going to be paying very close attention to the stability of your income. If you can show stability in the last 1 to 2 years or more, this is going to be very favorable for you in your credit application. Something else that's going to be very important is having reserves. If you're looking to borrow from an institution who you happen to bank with, this is going to be a very good internal data source for that institution. I'm huge about relationship banking on this channel. It's an extremely underrated financial ecosystem, relationship tool set many people take for granted and successful people don't. So when you have internal data for institutions that you're looking to borrow from, meaning that you are banking with them on a deposit side, you're giving them little seedlings of your financial behavior, having reserves is going to be essential to showing them that you're stable. Hopefully you have 4, maybe even 5 figures in reserves sitting and has been sitting for an extended period of time. This shows them stability and likely has also allowed them to make some profit on the other end by those reserves allowing them to lend out more money to other clients. Something else that you're going to want to do is, if you're not already borrowing from the institution you're looking to borrow from, you may want to prepare to start smaller. Don't go for the big fish in the beginning if you're brand new to a certain lender or creditor, or it's your first time borrowing with that lender or creditor. You may want to consider, depending on your credit profile and your financials. Now, obviously, if you're a prime borrower, you have an 800 plus credit score, and you have tons of money in the bank, this might not apply to you. But for those of you who, may be more working class or middle class and, credit score 680 to 720 range, maybe you have a little bit of cash in the bank or steady income coming in. You're not quite the ideal perfect borrower, but you're still a pretty good candidate, then you're going to want to definitely, look into starting small, maybe looking for secured loan options or small loans that you can start off with, show responsible use for a period of time. Look, this is going to take patience, but this is going to be another internal data point that lender is going to have without them having to overexpose themselves, or you having to take a denial because they're not willing to overexpose themselves. So these are a few tactics as a consumer that you can be taking on to try to continue to build strong relationships or create strong relationships with lenders and creditors at a time where they're going to be skeptical. Again, showing great job stability and income stability, good reserves, starting small with lending products if you don't already have a relationship with that lender. If you do have a relationship with that lender, you already have a credit card with them or some kind of loan, then staying stable on payments with that loan. And for credit card, in the cases of credit cards, you're going to want to maybe have great usage on that card, paying it off earlier than intended or earlier than necessary. It's going to look good as well, because all of this, again, shows financial stability and that you're in control. And this is what lenders are going to be looking for. Really quickly, for small business owners, you're looking at a pretty similar gambit as consumers. You're looking to show stability in the income of the business. You are the business in this case. So it's not as much just your income. The business needs to show consistent revenue, stable, and hopefully increasing revenue. So that means not only frequency consistency, but not major dips in the amount that you're getting paid, depending on your business type. You may have a business that always fluctuates no matter the economic circumstances in its invoices or income. But for those of you who, the business has some kind of stable, consistent earnings or deposits or pay coming in from customers or clients that you're working with, then you're going to want to keep that as steady as possible. And you're going to want to increase it if at all possible. This is going to be your version of deposit stability on your end. You're also going to want to have strong reserves for the business. This is something that myself, as a small business specialist, as a financial services expert, that I notice a lot with my small business owners. For some reason or another, you guys don't take savings very seriously with your business. And I understand that you want to take as much of that capital and reinvest it into the business. These times that we're in is exactly why you want to start building reserves. When I am helping my clients to establish business accounts, many of them ignore business savings accounts. And right now is exactly the prime time why you want to value those accounts, because now lenders are going to be looking for stability on a different level, and underwriters are going to be looking, at different criteria, looking for more stability. And one of the greatest forms of stability you can demonstrate is having cash on hand that you do not need to touch. months and months of reserves. This is going to make lenders feel much more comfortable extending credit to you. So if you have a small business, you have excess income or excess capital, if you can afford to do so, cut back on the reinvestment in the business and put some of that money in savings. It's going to pay off for you when you go to apply for new credit. The next thing you want to consider is also starting small. If you have not established a credit relationship already with a certain lender or creditor, starting small, or making sure you double down on your responsible use of existing credit products that you may have with a lender if you're looking to go to them for more funding. Again, you want to give them as many data points as possible, and you want to give them the opportunity to take as little risk with the highest reward possible. And the way you do that is by maintaining a strong income, maintaining strong reserves, starting small with borrowing, and then when you do have access to credit, being as responsible with it as possible. Like I said, using it consistently, paying it off on time, and even better, early. Pay it off in full if you can. This is another trick as a consumer and a small business owner. Pay off your debts in full, specifically with credit cards in particular, if you can. If not, pay it down to the lowest balance you can every single month. So again, I wanted to bring this to you because the economic climate is continuing to shift. You can see I'm putting out data and conversations around this every day. And honestly, I could be making 2 or 3 videos a day with as much information as coming out and things that are changing at the rate that they're changing. For you to continue to maximize your borrowing capacity, as a consumer or a small business, you are going to have to take different measures than you might take when the economy is doing well. And I hope you take these tips. I hope you wrote them down, took some notes, whatever the case may be, took some mental notes, because I'm telling you, these tactics are going to be golden in the coming months, to coming couple to few years we have going, because creditors and lenders, they're still for-profit entities. They're going to still lend, but they're going to have to be very cautious who they're doing business with. They can't afford to have a bunch of defaults pile up on their books in order to stay profitable and in order to continue to serve their shareholders if it's a publicly traded company. So I know this information was valuable to you. I enjoyed bringing it to you. This is JP from Blueprint for Prosperity. As you already know, I'm all about helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. I'm going to continue to bring you data, research, insight, and guidance to help you maximize and increase your net worth. I'm going to continue to put you in a position to win financially no matter what's going on economically. Thank y'all. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.